$11 billion.
Yeah.
It's quite a number.
It really is. That's how much illicit crypto funds have been frozen or recovered, partly thanks to blockchain intelligence.
Wow. And
Oh.
then you hear about the sheer number of crypto exchanges. Hundreds. It feels like a huge, complex world out there.
It can be, definitely. That's why today we're doing a deep dive to cut through some of that noise.
We want to give you a solid handle on the essential tools you need to navigate it all.
Exactly. We've looked at a whole bunch of sources: Money, Investopedia, Coin Bureau, FinSMEs, Ninja Promo, CrowdSwap, Chainalysis, even a Reddit thread.
Quite the mix.
Yeah, everything from best of lists and how-tos to expert analysis and what real users are saying. We're aiming to get you the core info on crypto wallets and related tools.
So think of this as your mission if you stick with us.
Which you are.
Right. Your mission is to get clear on a few key things, like why you absolutely need a crypto wallet.
And the difference between hot and cold wallets, that's a big one.
Also, custodial versus non-custodial. We'll break that down.
We'll also cover what to think about when you're actually choosing a wallet.
Plus, we'll look at crypto exchanges, the centralized kind and the decentralized ones.
And we can't ignore the buzz around AI trading bots,
Yeah.
right? The potential and the pitfalls.
Definitely touching on those. And we'll even briefly cover things like staking and yield farming.
And finally, point you towards some essential tools for trading, analysis, maybe some research.
Okay, sounds like a plan. So let's start at the beginning.
Yeah.
Why is a crypto wallet such a non-negotiable?
Well, crypto transactions are getting easier, which is great. But unfortunately, that also means theft and fraud are on the rise, too.
Right.
So a crypto wallet is basically your foundation for managing your digital currencies securely.
It's the starting point.
Absolutely. And it's super important to grasp the wallet doesn't hold the actual coins.
Okay. What does it hold then?
It holds the private keys. Think of them like the password or the key that gives you access to your crypto on the blockchain.
Got it. Keys, not coins.
Yeah.
Makes sense.
And this distinction between hot and cold wallets, it's not just about convenience. It really comes down to your risk appetite and how you plan to use your crypto.
So different wallets for different folks, different needs.
Exactly. Like
Yeah.
if you're just starting out, maybe only have a small amount, a good hot wallet might be fine. But if your holdings grow, well, the security of a cold wallet, that becomes pretty crucial for peace of mind.
Okay, so let's unpack those types. Hot wallets first. What are they exactly?
Hot wallets are basically software. They can be web-based apps, desktop programs, mobile apps. The key thing is they're connected to the internet.
Connected, so.
And convenient.
Very convenient. Great for everyday use, active trading, because you can access them easily on your computer or phone.
Any examples stand out from our sources?
Yeah, the Money article mentioned a few. Exodus was noted for supporting a lot of different cryptocurrencies.
Okay.
Zengo got a shout out for being really beginner-friendly.
Good to know. If you're mostly into Bitcoin, Sparrow and Blue Wallet were mentioned as strong options. Trust Wallet is seen as a good general mobile choice.
And I think I saw MetaMask mentioned.
Right. MetaMask is huge, especially for interacting with Web3 applications, decentralized apps, NFTs, that sort of thing.
So, hot wallets.
Mm.
Easy access, convenient for trading.
Yeah.
What's the flip side? What are cold wallets?
Cold wallets are the opposite in a way. They're physical devices, like a USB stick, but specifically designed for crypto.
Physical, so not connected to the internet all the time.
Exactly. They're kept offline, and that's their main superpower, security. Being offline massively reduces the risk of getting hacked online.
Makes sense. Any examples there?
The Money article pointed to the Trezor Model 1 as a good entry-level option, and the Ledger Nano Flex as maybe a higher-end choice.
And Ninja Promo had some too.
Yeah, they listed the Ledger Nano X, the Trezor Model T, which is a step up from the 1, and also KeepKey. Those are all well-known hardware wallets.
Okay, so it sounds like a trade-off.
Mm-hmm.
Hot for easy access, cold for maximum security.
That's the core of it. Hot wallets are generally more practical if you're trading frequently, buying and selling often. You need that speed and ease.
But if you're in it for the long haul,
Then cold wallets are usually the way to go. For long-term storage, what people call ode dealing in crypto.
right, hold on for dear life.
Yeah. Keeping those private keys completely offline in a cold wallet is just widely seen as the safer bet for HO dealing.
Gotcha. Okay, another distinction popped up in the sources. Custodial versus non-custodial wallets. This sounds important too.
It's absolutely critical. This one is all about who controls those private keys we keep talking about.
Okay,
With custodial wallets, a third party holds the keys for you.
like who?
Usually a crypto exchange. Like Coinbase, Binance, Kraken, FinSAMEs mention these. It's kind of like keeping your money in a traditional bank. They hold it for you.
Ah, okay. So the exchange handles the security of the keys. That sounds easier, maybe?
Yeah.
Especially for newcomers.
That's definitely the appeal. Simplicity, ease of use. FinSMEs also pointed out they often come with extras like potential insurance, customer support, things people are used
But
to.
there's a catch, I assume.
The catch is you don't have direct control. You're trusting the third party. And that leads to that famous saying, which the Money article brought up, not your keys, not your coins.
Yeah, I've heard that. It's pretty stark.
Okay.
So if you don't want someone else holding your keys, what's the option?
That's where non-custodial wallets come in. With these, you are in complete charge of your private keys.
So examples like MetaMask or those hardware wallets, Ledger, Trezor.
Exactly. They all fall into the non-custodial category. You manage everything. FinSME stress this gives you maximum security and control over your money,
But
but the responsibility is entirely on you. If you lose your keys, forget your recovery phrase, don't back it up properly.
then your crypto is just gone.
Pretty much, yeah. Likely gone forever. There's no reset button, no customer service to call.
Wow. That's a big responsibility. So how do you choose? Custodial simplicity versus non-custodial control.
It really boils down to your personal comfort level and your needs. If you value ease of use above all, and you trust the exchange or platform, custodial might be okay to start.
But if security and having that ultimate control is paramount.
Then non-custodial is the way to go, provided you're willing to learn how to manage those keys and recovery phrases securely. It's a trade-off you need to be aware of.
Makes sense. Now, the Money article also gave some practical tips for choosing any wallet. What were those key things to think about?
Yeah, they had 4 good questions. First, how often are we going to trade? Active trader. Hot wallet might be better day to day. Long-term holder. Cold storage makes more sense.
Okay. Frequency matters. What else?
Second, what specific cryptocurrencies do you want? Not all wallets support all coins. So check if it supports what you have now and maybe what you might want later.
Good point. Future-proofing a bit.
Third, budget. Hardware wallets cost money up front. Hot wallets are usually free to download, but check their transaction fees. Sometimes those can be higher.
Right. Cost is always a factor. And the last one.
Fourth, specific features. Do you want to do things like staking or lending directly from your wallet? Some offer that, some don't. So think about any extra features you might need.
Okay, super helpful criteria. So wallets hold the keys, but where do you actually do the buying and selling? That's the exchanges, right?
Exactly. Exchanges are the marketplaces. Investopedia and NinjaPromo both describe them as, the central hubs for trading crypto.
And just like wallets, there are different kinds.
Yep. The 2 main types are centralized exchanges, CEXs, and decentralized exchanges, DEXs.
Okay, let's tackle CEXs first. Centralized sounds. More like what people might be familiar with, maybe like a stock exchange.
That's a pretty good analogy, yeah. CEXs like Kraken, Coinbase, Crypto.com, Gemini, Investopedia listed. Those operate with a central company running the show. NinjaPromo also highlighted Binance and Kraken as top ones.
What are the advantages there?
Big ones are user-friendliness. They tend to be easier to get started with, especially if you're new. And usually higher liquidity.
Liquidity meaning?
Meaning lots of buyers and sellers. So it's generally easier to make trades quickly at the price you expect without something called slippage.
Ah, where the price moves before your order fills.
Exactly. High liquidity helps prevent that.
What about rules and regulations? Are CEXs more likely to be regulated?
Typically, yes. They often have to register and follow rules in the countries they operate in. Investopedia mentioned checking the FinCEN registration in the U.S., for example.
And security measures.
Many CEXs also offer things like crime insurance, or they use specialized custodians to hold the bulk of the funds offline, as Investopedia noted, adds a layer of security.
Okay, so CEXs sound good for ease of use, liquidity, maybe some regulatory comfort. What about the other kind, DEXs, decentralized exchanges? That sounds more crypto native.
It definitely is. DEXs operate very differently. They're platforms built directly on blockchains that let users trade peer-to-peer.
Peer-to-peer, so no central company involved.
Right. No intermediary. Trades usually happen via smart contracts, automated code that holds the assets and executes the swap when the conditions are met. Investopedia gave examples like Uniswap, Jupiter, DYDX, PancakeSwap.
Smart contracts acting like an automated escrow.
Yeah.
Interesting. What are the pros of that?
The big pro is you usually keep control of your private keys. You connect your own non-custodial wallet, like MetaMask, to the DAX to trade. You're not handing keys over.
Ah, back to the your keys, your coins idea.
Exactly. Plus, Investopedia mentioned fees can often be lower on DXs because they don't have the same big operational overhead as a
Okay,
CEX.
control and potentially lower fees. What are the downsides or things to watch out for?
Well, because they're decentralized, there's generally less regulatory oversight. You often have to rely more on community reputation and doing your own research to judge if a DX is trustworthy.
I'm probably a steeper learning curve.
Definitely. Using DXs typically requires more technical know-how than using a CX. You need to understand how to connect wallets, approve transactions, maybe deal with things like gas fees more directly.
So another trade-off. Control and potentially lower fees versus ease of use and regulation. Sounds like research is key no matter which type you choose.
Absolutely essential. Investopedia really hammered this home. Check the exchange's reputation, security practices, fees, what coins it supports, what trading pairs are available. Before you deposit any funds or connect your wallet, due diligence is paramount.
Okay. Now, speaking of risks,
Mhm.
crypto obviously has them. We saw that Chainalysis source.
Yeah.
What role do tools like that play in managing risk?
Yeah, Chainalysis is a major player in what's called blockchain intelligence or blockchain analytics. They basically build tools to understand what's happening on blockchains.
For what purpose?
Several things. Investigations tracing illicit funds, like we mentioned at the start, risk management for businesses helping exchanges spot suspicious activity, and security identifying vulnerabilities.
So they're kind of like investigators looking at the public ledger of the blockchain.
In a sense, yes. Their tech helps follow the money, map out networks, identify risky addresses or entities. They help exchanges and financial institutions comply with regulations by monitoring transactions.
And they are trusted.
Very much so. Top exchanges, law enforcement agencies, regulators worldwide use their tools. The fact they've helped freeze or recover billions in illicit funds, as we said, that really shows the impact these tools can have in making the space safer. It gives context to the risks, but also shows there are ways to fight back.
That's definitely good to know those tools exist. Okay, let's shift gears to something generating a lot of discussion. AI trading bots.
Ah, yes, the bots.
The Reddit thread we looked at had, well, a lot of different opinions. Can these things actually make consistent money? What was the vibe there?
It was very mixed, honestly. A lot of skepticism. Many users were like, look, the market's chaotic. Patterns might just be noise.
Like fool's gold patterns.
Kind of. The argument is that even if you find a profitable strategy, the market changes so fast, the edge disappears quickly. Consistently predicting the market is incredibly hard, even for humans, let alone a bot.
So the dream of just turning on a bot and watching profits roll in, maybe not so realistic.
That seemed to be the cautious view on Reddit. Some people pointed out that news events, sentiment shifts, things that are hard for AI to grasp, move markets drastically.
But not everyone was skeptical.
No, there were definitely more optimistic voices, too. Some argued bots could be good for things like arbitrage, exploiting tiny price differences across exchanges,
Oh.
or finding very short-term anomalies.
Okay, specific niches maybe.
Yeah, and a key theme was that for AI to really work long-term, it would need to constantly learn and adapt, not just follow fixed rules. True AI, not just automation.
Did anyone mention real-world examples, successes or failures?
Well, someone brought up Renaissance Technologies, the big hedge fund known for its quantitative machine learning strategies. Hugely successful.
But their methods are top secret, right?
Exactly.
Yeah.
Not something the average person can access. On the user level, experiences were all over the place. Some people claimed consistent profits, but often with warnings like, you need to be in the know, or watch out for scams.
And others lost money.
Oh, yeah. Plenty warned about bots failing, especially long-term, or just not performing as advertised. The big takeaway seemed to be, don't just rely on a bot. You still need to do your own analysis, understand the market.
So Reddit paints a picture of complexity, hype, and caution. What about Coin Bureau? Did they offer advice on using bots responsibly?
They did, and it echoed that need for caution. They really stressed monitoring the bot's performance constantly. Don't just set it and forget it.
Check in regularly.
Yes. Analyze its trades, see if the strategy is still working, be ready to tweak things or turn it off.
What else?
Understanding limitations is huge. Bots don't guarantee profits. Testing a strategy on past data isn't foolproof because the future market might be different, and technical glitches can happen.
Right, things can break.
Coin Bureau's message was clear. Treat bots as tools, not magic money machines. Active oversight and solid risk management are non-negotiable.
Risk management seems critical here. What kind of strategies did coin bureaus suggest?
Several key ones. Using stop-loss orders is vital, automatically selling if the price drops to a certain point to limit losses.
Makes sense.
Diversification, don't put all your trading capital into one bot or one strategy. Spreading risk is crucial.
Oh,
Regularly taking profits out, don't just let it all ride indefinitely. And having backup plans if the bot messes up or the market goes wild.
and security, if the bot connects to your exchange account.
Absolutely paramount. Coin Bureau emphasized choosing bots with strong security. Two-factor authentication, 2FA, encrypting data, using secure API connections to your exchange. You're giving it permission to trade your money, after all.
Very important points. Did Coin Bureau mention the kinds of strategies these bots typically use?
Yeah, they highlighted a few common ones. Grid trading came up, setting buy and sell orders at intervals around a price. Arbitrage, like we mentioned, trying to profit from those small price differences between exchanges.
Right.
And dollar cost averaging, or DCA automatically buying a fixed amount of crypto regularly, regardless of price. That's more of an investing strategy bots can automate.
Any specific platforms mentioned?
They listed several examples: Crypto Hopper, Shrimpy, Pionex, Tradeasana, Bitscap. They noted which exchanges they connect to, key features. An interesting one was Pionex, which apparently offers a range of bots for free. You just pay the normal exchange trading fees.
Interesting. Lots to explore there cautiously. Okay, let's shift focus slightly. Trading isn't the only way to potentially earn in crypto. We saw staking and yield farming mentioned in the CrowdSwap source. Can you break those down?
Sure, they're both ways to potentially earn rewards on crypto you already hold, but they work differently. Staking is simpler in concept.
How so?
You basically lock up your cryptocurrency in a compatible wallet to help support the operations of a specific blockchain network, usually one using proof of stake.
So you're helping run the network.
In a way, yes. By staking, you participate in validating transactions, securing the network. And for doing that, the network rewards you, typically with more of its native coin. CrowdSwap described it as generally lower risk passive income.
Like earning interest, but by contributing to the network.
That's a good analogy. Now, yield farming is different. It's more tied into DeFi, decentralized finance.
Okay.
Yield farming usually involves providing liquidity to DeFi protocols. You might lend out your crypto or, more commonly, deposit pairs of tokens into a liquidity pool on a decentralized exchange
Why would you do that?
to enable trading on that DEX. By providing liquidity, you earn rewards, often paid in the protocol's own token, or trading fees.
Sounds more complex.
It generally is. CrowdSwap pointed out that while yield farming can offer potentially much higher returns, higher APYs than staking,
There's always a but.
it comes with significantly higher risks.
Like what?
Things like the price of the tokens you deposited crashing, or vulnerabilities in the smart contract code of the DeFi protocol getting exploited hacks happen, and something called impermanent loss.
Impermanent loss.
Yeah, it's a bit complex, but it basically means if the prices of the two tokens you deposited into a pool diverge significantly, the value of your withdrawn assets might be less than if you had just held them separately. It's a key risk in providing liquidity.
So yield farming. Higher potential reward, but definitely higher potential risks.
Yeah.
Staking, more moderate reward, generally lower risk.
That's the basic trade-off. CrowdSwap also noted the underlying purpose is different. Yield farming fuels liquidity for trading. Staking secures the blockchain itself, making it run better.
So if someone's considering these, what should they think about?
CrowdSwap advised looking at your own risk tolerance. How much risk are you comfortable with? What kind of returns are you hoping for? How important is it to access your funds quickly? Yield farming might be more flexible there, while staking often involves lockup periods.
And research is key again, I assume.
Absolutely. Look at the annual percentage yield, APY, being offered. Understand any lockup terms, and critically, research the security and reputation of the specific blockchain or DeFi protocol you're considering interacting with.
Okay, wow. We've covered a lot of ground here. Wallets, exchanges, bots, staking, farming. If you had to boil it down, what are the absolute must-remember takeaways for our listener?
I think number one is you need a secure crypto wallet. Understand the types hot, cold, custodial, non-custodial, and pick what fits your needs and risk level. That's fundamental.
Okay, wallets first.
Second, exchanges are where the trading happens. Know the difference between CEXs and DEXs, and do your homework before using any platform.
Research, research, research.
Third, AI bots. Approach with caution. Understand they aren't magic. Monitor them, manage risk diligently, prioritize security. Don't just trust the hype.
Healthy skepticism needed.
And finally, things like staking and yield farming offer other ways to earn, but they come with their own sets of risks and rewards. Again, understand what you're getting into before you commit funds.
It really does all come back to being informed and making careful choices, doesn't it?
Absolutely. And for you, listening, hopefully this deep dive has helped demystify some of this, made it feel a bit less overwhelming.
Yeah, getting a handle on these basics is really that crucial first step to navigating crypto more confidently. But, and we have to say this again, always do your own thorough research before jumping into any specific tool or strategy. This is just a starting point.
For sure. And maybe take a moment now to think, what kind of crypto user are you leaning towards becoming? Are you thinking active trading, long-term investing, maybe exploring DeFi?
Yeah, reflect on that.
And then consider which of these tools, wallets, exchanges, maybe even bots or staking, seem like they might align with your goals and your comfort level with risk. Use this as a springboard for more specific research. Check out some of the names we mentioned.
Good advice.
Yeah.
And to leave you with something to chew on, here's a final thought. As this whole crypto world keeps changing so fast, with new tech always emerging, how do we as individuals strike that critical balance?
What balance is that?
The balance between chasing potentially high returns, which draws so many people in, and the absolute fundamental need for strong security and real control over our own digital assets.
That's a big
It
question.
really is. And how we answer that, individually and collectively, will likely shape where this whole fascinating space goes next.